I didn't have a down payment. I didn't have the money. Like, I was sitting here thinking, I don't have the balance sheet to get a bank to get interested in this. And even if they did, I don't have the 60, 70 grand that it was going to take for the down payment part of this. He's like, why don't you talk to the banks? I bet they'll like it. Why don't you talk to them? Welcome to Commercially Speaking, the podcast where I teach my little brother all about commercial real estate.
This here is my brother, Bo Barron, CCIM.
And this is my brother, Timmy Barron, ADHD. This is Commercially Speaking.
Oh yeah, very good. That mojo's running now. Oh yeah. Bo, why don't you teach me how someone would go about doing their first commercial real estate deal?
All right. I think there's 4 or 5 ways that I can think of, and I'll just kind of name them and then we'll go through them.
Okay.
One is you just pay cash. All right. You save money, you pay cash. Next, you use financing. So you just like buying a house, you'll bring a down payment to the deal. You'll finance the rest, and then you buy something. All right. Another one is you can get like a money partner or a silent investor. And a lot of times they'll bring the down payment. You can finance the rest. Or maybe they just do the whole deal. They bought equity in the deal. They're an owner. And then you can do a syndication. You basically put a group of investors together and do a deal. And then the last way, and this is actually how I did my first deal. I'll tell that story in a minute. But you go borrow the down payment, and then you go get financing from a bank for the rest of it. And you bring 100% debt to the deal. So let's start with number 1.
Yay.
You're just going to pay cash. Now, there's some pros and cons here, obviously. One pro is you seriously minimize risk if you're not bringing a bunch of debt to the deal. Your cash flow is a lot higher if you pay cash for a deal because you're not paying all this debt service on a monthly basis.
Yeah.
So there's just a whole lot more cash. But there's some cons to this type of deal as well. Like, how long would it take you to save up $500,000 to buy, a small office building?
Mm-hmm. Couple months.
I mean, that's a couple months. If you think about most people who work 30 to 40 years of their life and they want to save up $500,000 to buy a pretty small commercial real estate investment, that might take them 30 to 40 years.
Mm-hmm.
They might go into retirement with one whole deal. It just takes a long time. So in my 20-year career, helping people buy and sell real estate, I've seen a cash deal just a couple of times. And these were guys, they weren't doing their first deal. They were doing their 20th deal. Mm-hmm. And they had the money now where they could just pay cash. Most of the guys that can do that still don't want to do it. That actually helps you shelter more of your income. What debt allows you to do is if you can make, say, a 10% return, but you can borrow money at 6%, then that spread of 4% there increases your return.
Okay.
So if you're going to make 10% on the deal and you got to borrow at 12%, you're going to have negative leverage.
If you have the cash, would that be the ideal way to do it?
Like if you want the safest thing, if you don't bring debt to the table, you're minimizing your risk. In that case, yes, it would be better. If you want a better return, then no, cash might not be your best option. A lot of this depends on the person doing the deal and what's their risk profile. Like what keeps them up at night? What are they trying to accomplish?
The goal of the investor will come into play whenever you're trying to pitch somebody to invest in a deal that you're putting together.
Yeah, absolutely.
Yeah.
But if we're just thinking about, the listener here is sitting there on the other side of this episode thinking, how can I pull off my first deal? One of their options is save up all the money you need and then go find you a deal and buy it with cash. It's going to take a long time, but you can do it.
Mm-hmm.
The second option is just traditional financing. Yeah, you've bought a house, I've bought a house. Looks a lot like that. You're going to bring a down payment, 20 to 30% maybe. You finance the rest. Matter of fact, the last number of deals that I've done where I've put financing on the deal, I try to keep the financing to about 60%. The return would get better if I borrowed more, but it increases the risk, and I like a real nice margin of error. Here's some other things about traditional bank financing. These days, they're going to do probably a 5 to 7 year term. Just a couple of years ago, they were doing 10-year terms on a 20-year amortization, sometimes 25 years of amortization, sometimes 15 years of amortization. Now, what that means is the loan is spread out over 15 years. Well, let's just say it's 20 years. 20-year amortization. The term of the deal, though, is 5 years. So I'm paying my monthly mortgage as if it's going to go over 20 years. But at the end of 5 years, I have to pay it off. There's a balloon payment at the end of 5 years.
Oh.
Now, it's not this way when you buy a house. You have a fully amortized loan, 15, 30 years, something like that, and you just pay for 15 to 30 years. There's no balloon payment.
Yeah.
Commercial loans almost always have that balloon payment, which means at that moment you have to sell the property or you have to refinance. Now, imagine what just happened over the last 9 months. The interest rates have gone up and up and up and up and up. Let's say I did a deal 4 years ago with a 5-year term. In 1 year from now, I'm going to have to pay it off by either selling the property or I'm going to have to refinance the deal at today's rates.
Hey.
So now all of a sudden, the financing part of the deal doesn't look so good.
Right.
Maybe it looked really good at 4.5%, but a year from now, we might be at 7.5%. Matter of fact, right now, about 20 to 25% of the commercial mortgage-backed securities, CMBS loans, these are the big type of loans on really big properties. About 20 to 25% of those are coming due in the next year. They went under, I don't know, probably at somewhere 3, 4, 4.5%, and now they're going to have to refinance or sell a quarter of the properties under a much less favorable lending environment. And it's going to cause a lot of people to have to sell, which if you're a commercial real estate broker, I guess that's a good thing.
Because there's a lot more to buy.
Well, when people have to sell,
you have to help them sell it.
Deals are going to happen. When all these rates started going up, I started looking at our last couple deals. The deal we did 18 months ago, I've got a 7-year term on. So that takes me to 2029. I don't know what 2029 is going to look like, but I'm going to have to refinance or sell the property when we get to 2029. And hopefully the lending environment will be better than it is right now.
What was the rate?
I think it was 4.2. So if I had to do that right now, my cost of funds would go up about 50%. Anytime you take out a loan, you're betting on the future and it adds risk to the deal. But a big difference about a commercial loan versus a residential loan, you got a balloon payment at some point, and that can cause some problems depending on what's going on in the world that you have no control over.
Right.
When that balloon comes due.
Why do that? Is it because of the interest rates change? So to just keep up with that?
Yeah, look, when the interest rates are really low, a bank is going to want a 5-year term or a 7-year term because they want you to have to refinance at a higher rate. They make more money. It allows them to recast. They don't get stuck with these commercial deals that are 20 years long.
Yeah. Okay.
They kind of recast it every 5, 7, 10 years, depending on the term. And it protects their downside a little bit.
Yeah.
That's my guess, at least. That makes sense to me. I'm not a lender.
So, it seems like they're just trying to not have you stuck at a great rate because that would be awful for the banks. Okay.
Well, look, they're not going to do a deal that they don't make money. Okay.
Sure.
So when I did that deal at 4.2, like they're going to make 4.2 on that money. But 5 years from now, if we're at 7, they're behind the market. And so by having a shorter term, they get to catch up. They're just protecting their downside.
Sure.
I get that.
Yeah, I get it.
Now, there's another type of financing like this. It's called hard money lending. And it's a type of financing. All right, so we're still in category 2 here. You're still going to have to bring 20 to 30% down. You still got to come up with that money. But the difference with hard money lending is, whereas a bank might take 45, 60 days to approve the loan, there's like a big process they go through. Hard money lending, these folks are either individuals or they're companies, and they can make decisions within like 48 hours and fund a deal. They can move very, very fast. They charge mid to high interest rates. So if banks are your cheapest option to borrow money, if your credit rating's not real great, you might have to go to a hard money lender. The other thing they do is the loan term is generally 1 to 3 years. So it's very quick. These guys, they want their money back quickly, and they're generally interest-only loans. So oftentimes a hard money loan might be 20-year amortization, 15-year amortization, 1-year term, interest only. So all you're doing is paying the interest. And then at the end of that year, you have to refinance, probably with traditional lending. You pay the hard money guy off, and you have normal financing at that point. That's kind of the model. And this happens a lot with like fix and flip type deals where you buy, a rundown house for cheap, put some money in it, flip it. That process might take 6 months. So a hard money loan might be a better option. I can get approval real quick. I just pay interest. And then once we flip it and sell, we just pay the thing off. And hard money loans rarely have a prepayment penalty. Commercial loans from a bank often have a prepayment penalty. You want to pay that thing off early? They might charge you 1, 2, or 3% of the loan to do it.
Dang.
So the last 2 deals we did, I put together a package, my financial statement, all the underwriting I'd done on the deal, the last 3 years, tax returns, all the things that banks are going to want to see from me. I put it in a Dropbox folder, and I shared it with about 7 banks. And I basically made them compete for the deal. I like all these guys. I've done brokerage deals where these guys have been involved. They're good at what they do, but every bank doesn't love every deal. And some of them favor certain kinds over others. And I was shopping for a good deal. So I put them in competition with each other. And one of the things we were negotiating is I don't want a prepayment penalty.
Yeah.
Anyway, back to hard money loans. Interest only, generally about a year, and you got to pay it off. They're also more expensive in that they charge points. Have you ever heard of points in a loan?
No.
Like if there's 2 points on a loan, that's 2% of the loan that they charge you up front as prepaid interest. You don't want points. Hard money loans, they generally charge 3 to 5 points up front. It's inexpensive, but sometimes it might fit the deal you're trying to do.
Yeah.
And sometimes if a commercial lender doesn't like the deal at all and you can't get a bank interested, you might be forced to go the hard money route.
Right. Go get myself a hard money loan. Ugh.
Mm-hmm. I'm sure there's a lot of jokes going through your head with a term like hard money lending.
So many.
Let's leave them out.
God, yeah. I'm glad you said that out loud because it was very distracting, all these jokes in my head.
You looked like you were really struggling.
Oh, my God. Yeah.
Hey, let's take this moment to use the restroom.
Okay, great.
All right, I'll be right back.
Yeah? Are you having fun yet? Bo and I are working very hard to help you live a more fulfilling, happy, successful life. Please subscribe to our channel, hit that notification bell, and ask us any questions you have in the comments. Okay, back to the good shit. I do got a quick question before we move on from hard money loans.
Okay.
Like, I know you're not in the business of building homes, but I know like dad used to, or granddad used to, right? So if you're going to erect a building, if you need money for your erection, is a hard money loan, is that an option?
It's not your best option.
I didn't think so.
That's a good one.
Yeah.
That's pretty good.
I think so.
Yeah. You don't want a construction loan, just to answer your actual question.
Oh, a construction.
Those are different. Don't really apply to what we're talking about today.
Sure.
So you want number 3?
Oh, yes, absolutely. I bet I could tell you what it is. A silent investor or a partner.
Money partner or a silent investor or silent partner, anything like that. Here, what you're doing is you're going to somebody who's got some money and they want to partner with you. And normally this often looks like they don't really want to do anything. They're going to give you the money and you're going to do all the work. And what you're going to do is you're going to trade your sweat equity. You're going to trade your time. You're going to trade your expertise. You're going to trade the time that you spent finding the deal in the first place. You're going to trade it for equity. They're going to give you maybe 20, 30% often what the down payment would be. And then you'd go get financing from a bank. So here you're going to give some equity up in the deal. So let's say you're the rich guy and I found a deal and I don't have the money to do it. And I talk to you, I kind of pitch the deal to you. You're like, man, that sounds pretty good. I want to take some of this money I got sitting in the bank and put it into a property so it can be making some money for me. Let's say you put up 30%. I bring 70% financing to the deal. We would then negotiate the equity split. It might not be 30-70. Maybe you want half the deal. I got a buddy of mine in Bowling Green who has had some success with this. He's got some money partners. Essentially they're like, look, we like what you do. We believe in you. We know you're going to be able to make us money. And so you put the deals together, you come to us, and we're going to have interest in that, and we're prepared to fund it. And so he gets some money from them, probably puts some money in himself, goes and gets some financing. Now, if we're talking about the person doing their first deal, this might be a little bit more challenging. If you're doing your first deal, you don't have a track record yet. You don't have a history of making your partners money or anything like that.
Mm-hmm.
I always think back to, Godfather 2. Hyman Roth always makes money for his partners.
Mm-hmm.
You remember that?
I got
Godfather 2?
Yeah, no.
Come on, you're the movie guy.
I know. There's some really classic, amazing, big movies that everyone has seen that I have not.
What are some of the others that you haven't seen?
Say hello to my little friend. Scarface. Haven't seen Scarface. I haven't seen
It's against Al Pacino or?
Taxi Driver. No, I like Al Pacino. I like Al Pacino enough, Yeah. Yeah, I mean, if you were to name some like really big movie, you told me about Glengarry Glen Ross.
Yeah, but I don't know how big a hit that was.
I mean, it's huge.
Man, what a cast.
Sam Shepard, just an incredible writer.
I was listening to a podcast where Bono was on, and he said he learned about America from Sam Shepard plays.
Nice.
Well, how about that?
What podcast was that? Which one was that? Because I listened to one with him.
Smartless.
Yeah, I listened to that one. Par and I are huge fans of his daughter. She's in one of our favorite shows.
Daughter?
Yeah, she's in Bad Sisters. Great show. And she's awesome. Like, she's amazing. Anyway.
We'll have to check that out.
Yeah.
So if you're trying to do your first deal, we've got pay cash, get financing, traditional or hard money. And you could also find you kind of a sugar daddy, a silent partner. Now, the fourth way is to do the syndication. And if you think it's difficult to do your first deal with a money partner without a track record, it's even more difficult to do a syndication, but it's possible. Mm-hmm. I will tell you, I tried to do my first deal as a syndication, and it failed. But here's what a syndication is.
Okay.
A syndication is where you take a group of investors, you create an LLC or a limited partnership, and these group of investors, they buy into that LLC. So the money goes in to this limited liability company or this limited partnership. And then that company goes and buys the property. Now, because you're not selling interest in a property, but you're selling shares essentially in a company, this is a security. It's governed by the SEC, Security and Exchange Commission. Mm-hmm. And they have a lot of rules. Now, there's a lot of different ways that you can do this. But the way I've done it, well, I attempted it 4 times. I've successfully done it 3 times. And the rule that I do it under is 506B Reg D. What that means is I've got a limit on who I can take. I have to take qualified investors, and I can take some sophisticated investors. Mm-hmm. Qualified investor is somebody who has $1 million in net worth outside of their house. And they have to be clearly sophisticated, meaning they're smart enough to understand the risks of the deal. A sophisticated investor, unlike a qualified investor, is smart, but not so rich. So they don't have the net worth qualifications. They don't have that $1 million in net worth outside of their home. Clearly, they are smart enough to understand the risks of the deal. Those rules are in place so that you don't swindle out a sweet blue-haired lady and they won't be taken advantage of.
Most people with blue hair in general.
Oh, well, that might be true. Another rule is I have to know you. I have to be able to substantiate that we had a relationship before the deal. Mm-hmm. So let's say you live next door to a rich director there in Chicago. You introduced him to me after I was raising money for a deal I was trying to put together. I couldn't take his money. I didn't have a relationship with him before the deal.
Unless
if I brought you into the deal as a principal in the deal.
Yes, okay.
So part of the general partnership or the sponsor side of the deal, then I could take his money.
Yeah, okay.
And you would earn equity in the deal by bringing money to the deal that I couldn't take without you.
I like that position. I like that one a lot. Yeah. You just introduce the people with money.
The other things you have to do is you have to create a private placement memorandum, operating agreement, subscription agreement. There's a lot of paperwork that goes into doing a deal like this. So you have some expenses you might not have in these other types of deal structures because you're hiring attorneys to do all that. And attorneys, turns out, are kind of expensive.
Yeah, they are.
So in a syndication deal, the way I've done them is I might raise 35% of the deal from a group of investors, and then I'll finance the rest. So just like all of these deals, it's kind of like if you're not going to pay all cash for it, it's really where does the money come from? Financing could be a part of it. You can, get the rest of the money, the down payment, either from yourself or from a silent partner or from a group of investors. There's a lot of different options on how to do this. There are a couple other ways you can do a syndication though. The way I've done it in the past that I was just describing is I find the deal that I want to do. Then I put the group together and we go do the deal. So when I'm meeting with an investor, I'm saying this is the deal, and they can decide to do that deal or not. Another way to do it is you raise the money first. These are generally referred to as funds. I'll raise a fund of, say, 10, 20. Some of these people put these big funds together, hundreds of millions of dollars, and then they'll go find the deals.
Aha.
Now, if you're an investor thinking of that, you really have to trust the sponsor of the deal.
Mm-hmm.
You don't even know what kind of properties you're going to buy yet. Or maybe there's probably going to be a plan. We might be going after single tenant net lease retail deals. We might just be doing apartments, triple net industrial deals or whatever.
Sure, of course.
Probably have a plan, but you're betting on the sponsor to be able to go find the deals.
Yeah.
And deploy that capital to create a return. I've never tried to do that. And then there's a third way that's kind of new, and it's called crowdfunding. Have you ever heard of crowdfunding?
Oh, yeah. Are you kidding?
Yeah. So it's a version of, what are the websites that do crowdfunding?
Kickstarter.
GoFundMe. Yeah, Kickstarter, GoFundMe.
Yeah, GoFundMe, Kickstarter.
These are just big versions of that. You didn't used to be able to do this, but they changed the laws. And so now you can do it. You can crowdfund. You can get $1,000 from 1,000 people, take that $1 million and go buy a piece of property.
Oh,
you don't even have to know. That's different than my 506B Reg D rule. Like, I know how to operate in that rule. I really don't know the rules for these other types of
crowdfunding,
but you can do it.
Is there like a site like Kickstarter? Is that what it is? Like you start a campaign and then people can buy in?
Yeah, it's kind of similar, except what I would do is, there's applications where I would use that application to create my own, and then we would go out and market, like mass market the deal. I'd be running Facebook ads or whatever else,
right?
Try to drive traffic to this site that's specifically for my fund.
Yeah, gotcha.
I'm sure there's a dozen or more different ways to do a crowdfunding syndication deal, but
yeah,
it's probably not a great option for somebody's first deal. And here's why. Syndication in general is not a great option for somebody's first deal. And that's what I tried. So I had this 12-unit apartment complex I found. I was doing a deal where these folks out of Michigan were selling a 172-unit apartment complex. I'd found the buyer. We had the deal under contract. They called me up and they said, hey, look, we've got, we're selling these 172 units, but we've got this 12-unit apartment complex on the other side of the town. And do you think you could sell that as well? It's like, well, I'm sure I could probably find a buyer. I took a look at the deal and I was like, man, this could be my first deal.
Yeah.
I was probably 34, 35, something like that. I've been in the business 6-7 years. I hadn't owned anything, just learned about the syndication, taken a course. I felt like I knew how to do it.
Sure.
I knew how to talk about it. I knew how to explain it. So I thought, man, I'm going to do it. I put this deal under contract and I started meeting with people, orthodontists, the rich wife of the hospital CEO, all these different folks.
Old fraternity
and I
brother.
put together enough money. He's in my latest deal, but I had no fraternity brothers in this first deal.
Sure.
And it looked good. And then all of a sudden it was time for them to put the money in the deal and they all backed out. I don't blame them, frankly. I was young. I had no track record. They were going to have to trust me to make them money. And look, with our last name in this town, that comes with some credibility. I'd been in the business for a short period of time, but I'd had some success. That came with some credibility. But when it came time to write the check, they just didn't trust me enough. And I don't blame them. Man, I was really bummed in my office. The moment I realized, I was like, this isn't going to work. We didn't use the term back then, but they were ghosting me all of a sudden.
Yeah.
And I was like, man. And I had this pit in my stomach the whole time thinking like, why are these people actually acting like they're going to give me money? Like I wouldn't give me money at this point, I was like, this is going to go south. And it went south. And I remember when I realized that, I was just sitting in my office. I was looking all bummed. Dad walks by. It's like, what's wrong with you?
What's going on there?
It's like, this deal isn't going to work. Everybody's backing out. They're not returning my calls. And it's like, I'm bummed. It was a good deal. He's like, so you like the deal? Yeah, I like the deal. I think it was going to make us some money. And he's like, well, why don't you just buy it? I didn't have a down payment. I didn't have the money. Like, I was sitting here thinking, all right, I'm not going to buy cash. A bank's not going to lend me money. I don't have a silent money partner. I know Dad hates partnerships. And I was like, I'm not bankable. I don't have the balance sheet to get a bank to get interested in this. And even if they did, I don't have I don't remember, 60, 70 grand that it was going to take for the down payment part of this. He's like, why don't you talk to the banks? I bet they'll like it. Why don't you talk to them? Well, like, all right. So I started talking to some of the banks, and it turns out they wanted to get their claws into young Barron. They all liked the deal. They all wanted to do it. So then my next problem was, where am I going to get this down payment? And this leads us into the fifth way to do a deal.
Uh-huh.
The fifth way to do a deal is to borrow the whole dang thing. And this is what I did. On Dad's suggestion, I went and met with Granddad. I pitched him the deal, and then I had to get it past our aunts, who are, I think he was getting up there in years, and I don't think he was quite as sharp as he had always been. And they were just taking care of him. And so I pitched the deal to the three of them. They decided to lend me the down payment on some pretty good terms for Granddad and for me. So borrowed some money from Granddad, took that money, paid the down payment, borrowed the rest of it, and went into that deal with 100% financing. I had zero of my dollars in this deal, and that is a bad idea. Now, I'll tell you, the deal worked out. The problem is when you go in with 100% financing, everything has to go right. There's so little margin for error.
Sure.
And if anything goes wrong with the property, if you have tenants that stop paying, I had some crazy things happen. I had somebody commit suicide in one of those units. I had, I had this one day I get a call from Dad. It's about 9 o'clock at night. And he says, hey, this detective is about to call you. And it's the detective that he would play racquetball with in the mornings. And he called this guy.
Meatloaf?
I'm going to say like pork chop or something.
Yeah.
It wasn't meatloaf. I think it was pork chop.
Yeah, pork chop. I think you're right, yeah.
Yeah. I wanted to say lamb chop, but that's not right. I think it was pork chop. And he said, yeah, this guy's going to call you. I let the drug-sniffing dogs go around our self-storage facilities, and they hit on one of those units, and it's your unit. It's like, what? I stored appliances from my apartment complexes, like extra appliances in that unit. So like just the stuff I didn't have space for on the property or whatever. And I also let my maintenance guy use that unit. So my first thought was, oh, my maintenance guy is going to get some, like I automatically thought whatever they're sniffing is going to be his. So we actually called the maintenance guy and acted like he needed to meet us there with the key because we couldn't get in, like we'd lost the key.
Yeah.
Like it was a sting or something.
Yeah. So fun.
And so he did. Cops are there. He opens up the unit. They identify, it was like a dryer, like a clothes dryer that was sniffing.
Oh, okay.
I said, that dryer came out of unit 12, unit whatever. And I said, well, who is your tenant? Do you remember? And I was like, yeah. And I said the guy's name, and they were like, that's why we hit. Like, we know that guy. So I had a guy using drugs, I don't know what it was, in my apartment unit. It got residue in the dryer, which ended up in a self-storage facility that our dad owns, that hit when the drug sniffing dogs, and I got to go hang out with Pork Chop and my maintenance guy and Dad for about an hour and a half one night.
When Dad came to you and said, he called you, right? 9 p.m. Was there a tone in Dad's voice that sounded like this was, you've got something in there, son? Or was it more of, hey, this is like matter of fact, this is going to happen? You know what I mean? Sometimes I think I make up that tone in my head when Dad just talks to me, but
I don't remember any tone. I think I was getting the benefit of the doubt.
Yeah. Okay.
And we had both used that maintenance guy, and we both knew that he used my unit. And I think our minds both went to the same place. Like, he's the problem.
Yeah.
And so yeah, there was no undertone of accusation in the call or whatever. But when the cop called,
that must be new.
He identified, this is Detective so-and-so. And I was like, oh, are you the one my dad called Pork Chop? I thought it would be funny. Nothing. Crickets. He did not think that was funny.
Yeah.
At all. It was a bad idea. And all of a sudden I'm trying to act like I didn't just say that. And
right.
it was bad, but
probably because he was on the job. I've met him a few times at the racquetball court. Granted, I didn't call him Pork Chop. I said, nice to meet you, sir.
Sir, yeah. Nice to meet you, detective. That's probably what I should have done.
Sir, yeah.
So anyway, we bought those apartments, with everybody else's money and none of my own. And it was tough. We had some really lean months there because at the time There wasn't much rent growth. And I pretty much had to keep that thing full or I wasn't going to be able to pay granddad and the bank.
Yeah.
And that's the problem with putting that much debt is you don't have the cash flow to handle any curveballs, and there's always curveballs.
Yeah.
So I would not recommend doing that.
Yeah.
If I had to go do it over, I'd probably try to figure out a different way.
I mean, what's the other option if you don't have the capital?
If I could have found somebody that could have stroked a check for about 70 grand and given them some equity in the deal, that would have been a better option. I would have had a partner, which I don't always love. And the second syndication deal I tried, it's 48 unit apartment complex. The first guy I pitched it to took the whole deal.
Wow.
Which I was like, this is great.
Mm-hmm.
But the way a syndication deal tends to work is the sponsor, the guy who puts it together, has all the authority and all the responsibility.
Mm-hmm.
And the group of investors have no responsibility and no authority. They have a little bit of authority, like they can replace me if I'm not doing my job or whatever. But, you know, the day-to-day stuff is the sponsor's responsibility. And what I ended up there with a group of one who put all the money up, in reality, I got myself a partner.
Yeah.
Who had different opinions on how to run the property and kind of had the authority by virtue of the fact that he put all the money in the deal.
Yeah.
And it didn't work out great. So a number of years later, like we made a deal and he bought me out of the deal and kept it himself. And that worked out okay, but it harmed that relationship.
Even today.
Probably wouldn't do that again. Even today.
Even
like
today.
We saw each other now. We'd be friends. We'd be civil, but I wouldn't pitch him for another deal.
Yeah.
He wouldn't come into another deal, probably.
Yeah.
It's a shame.
When you said that it ended okay for you, or ended okay the whole deal? Like, did he walk away? What's the status of it now? I'm just curious.
I did okay. He did great.
Oh, he did great. Oh, well, that's a shame. That's a shame. Y'all were butting heads on creative control, and I guess he was right.
He paid me to go away.
Yeah.
And I did. And that deal was okay. I can live with it. And he kept it for a few more years. Market went crazy. Everything accelerated in value, appreciated quite a bit. And he sold at the top of market. Matter of fact, when I sold that 12-unit apartment complex, I set a record in Owensboro for the highest price per unit for an apartment building. I had it until he sold that other deal we did.
Oh.
And then he broke my prices. So those first two syndication deals were the record setters for price per unit for a little bit.
Wow. Hey, but it's nice to have somebody pay you to go off, you know? That's never happened to me. Not yet. Not yet.
Well,
oftentimes if someone's trying to get me out of it or out of whatever it is, I end up having to pay a fine. We'll talk about that on another episode, maybe.
I have a Quickie Quiz for you. Are you ready for a quiz?
Yeah, quiz. But before we go into this pop quiz, I love this idea. And listener, answer the questions in the comments. See if you can do better than me.
You have questions about any of this stuff, throw it in the comments as well. And you might even give us some ideas for future episodes. All right, you ready?
I am.
What is a balloon payment?
Okay, cool. A balloon payment is a payment that you have to, it's for, when you finance, oftentimes when it's for commercial real estate, something so big, they will lock you in to like 5 to 7 years before you have a balloon payment of the rest of it that's due, which forces you to refinance at whatever interest rate is happening, or you have to sell. So the balloon payment.
Okay, so
yeah.
Let me rephrase what you just said, because you're essentially right. On commercial deals, they're often amortized over about 20 years, much like your home might be mortgaged, amortized over 30 years. But they're not fully amortized loans because they have a shorter term. So at the end of a shorter term, like say 5 years, which is normal right now.
Mm-hmm.
So a 5-year term on a 20-year amortization, you owe the remaining balance of the loan, which is the balloon payment at the end of the 5-year term, which forces you to sell and pay off the loan or refinance and keep the deal, which is essentially what you just said.
Right, but there are some specifics on it, like amortization or amsterdation, Amerston
That's
Station?
exactly right. Yep.
Yeah.
Is that somebody's name?
I don't know.
Amherst Station?
Amherst Station?
Like a train stop.
Apton Nation. Okay. Would you grant me a full point on that?
No, I'd give you a full point on that.
Okay, great.
You got the concept for sure.
Yeah. I knew balloon payment was that big payment you had to do at the end of a term. Okay.
Yes. Very nice. All right. Question number 2. A hard money loan is unique in that its term is generally a year and the payments are what?
Hard money loan. Man, I was thinking of so many jokes during that section. All right, to repeat the question again. They're unique because their terms are a year and their payments are interest. It's interest-only payments.
Interest-only payments. That's exactly right. King Things. You are 2 for 2. Very nice. I don't know if I'd flex if I were you. All right. Who regulates syndication deals?
Okay, what do you mean by regulate? What do you mean by regulate? Would that be the person who's the principal?
No, there is a government agency.
Yes, okay, I know who it is. The SEC.
Which stands for?
Security and Equity Commission?
Security and Exchange Commission. But you got the SEC, right? I just wanted to make sure, since it's March Madness happening while we record this, that you weren't thinking the Southeastern Conference, since you're such a huge basketball fan.
Go Wildcats.
I'll give you that one too. So we're 3 for 3.
All right.
At this point. All right. 2 more questions.
Yeah.
What is the biggest downside or con to borrowing 100% of the money to do a deal?
You have no wiggle room for mistakes, is one way to put it, because all that money is money that you owe back to whoever it is. So,
to say it another way, because you owe so much, there's almost no cash flow.
Yes,
because you have a smaller amount of cash flow, you have very little ability to adjust and adapt to curveballs, expenses that might happen during the course of the deal.
If you want a business to fail, deprive it of cash.
That's exactly right. Same thing with a deal. I mean, it's exactly the same thing with a deal.
I don't know if I get a point for that because cash flow did not come into my head. Maybe what I was describing was along...
You described cash flow.
I did, yeah.
Yeah, you just didn't say the magic words.
Okay, cool.
All right. Maybe I'll grade you harder as we move forward.
Okay, cool. Fair enough.
Conceptually, I think you're 4 for 4 here.
Okay.
All right. When you do a deal with a silent partner, the silent partner brings cash to the deal. What do you bring?
Your expertise, your sweat equity, basically. Right.
They're paying you. Yeah, that's exactly right. It's your sweat equity. It's your time. You generally found the deal in the first place. You're putting in your time and expertise. You're getting equity in the deal because of all those things, and you're giving up some equity to the deal to the silent partner who's putting in the cash.
Yeah.
Well, man, 5 for 5. It seems like you were listening.
I was listening. Some moments I wasn't. I love the pop quiz at the end, Bo. I love it. It gives me a huge hit of dopamine. Nice. So next week, Bo's going to actually pitch me a deal. We're going to do a mock pitch. A mock pitch with slides and everything. You don't want to miss that. You can follow Bo on social media at Bo Barron CCIM. Mainly Twitter, right? Anywhere else, Bo?
Mainly Twitter, and I'm trying to figure out Instagram a little bit. I'm getting better at these things.
Yeah, I can help you.
You can find us on YouTube. Where?
At Commercially Speaking. That'll be on YouTube, TikTok, LinkedIn, Facebook, Instagram, and then it's an abbreviated version of that on Twitter. Follow Bo on Twitter.